Mike, I'll go to you first because the market reaction was fascinating. I mean, especially when you saw volatility just collapse during that Fed press conference. What was your takeaway from this?
You know, I think Powell got a little bit lucky in the PMI data this morning, quite honestly. Had he been on the dovish side and you had a strong PMI print, I think you would have seen a very different reaction from rates today. You know, at the end of the day, you want the Fed to be somewhat hawkish because by being hawkish, the Fed is saying we're going to control long-term growth and inflation expectations. So if you're a buyer of 10 or 20 or 30-year paper, you actually want the Fed to tighten monetary policy. So he got a bit lucky today in the weak economic data. What I'm fearful for is what happens if the economy starts to reaccelerate. And we've started to see that, right? I mean, 4.9% GDP in Q3. And then the market says, oh, wow, you know, to Steve's point, Powell was somewhat dovish, but growth is heating up. Then you get a big bear steepening of the yield curve again, rates go higher, that could be bad for risk.
But Powell did see the market heating up going into this. So he already knew that. So I think this was almost Goldilocks. But this is a question for you. Has the Fed ever continued QT while they're cutting rates?
They haven't. They haven't had to. No, absolutely not. But this time around, they said that they're going to. You know, they're going to continue with balance sheet runoff even while cutting rates. But we also think, no, that, you know, cutting rates isn't for quite some time.
Yeah, I thought that was an important point, and I think the bond market reacted like just another little leg, stronger yields lower when he definitively took that QT, early exit of QT off the table. That was interesting to me because I wasn't know how much was priced in there already. Maybe some, because the reaction was kind of just another leg.
Yeah, I mean, I think the Fed wants to really normalize the balance sheet. And I don't think this is a 2024 type story. I think this is going to be for the next 10 years. Right? You had a decade of quantitative easing and easy monetary policy, and you're probably going to have a decade of balance sheet normalization, meaning quantitative tightening.
Well, and it's not just our Federal Reserve, it's central banks around the world. And so I'm going to say that the most important thing that happened today was not the Fed, it was the refunding announcement, and it was where they were refunding. So bill heavy, note and bond lighter than expected. Still heavy because we've got a huge deficit to finance. That was the 20 basis point almost intraday move from the highs in the open to the lows in the 10-year and the 2-year. So the entire curve felt it, even though we know that the Fed is, and the government essentially is going to go out there and have to finance a big budget deficit. That, to me, is what this is all about. And that, to me, is where Fed Powell is just kind of like sitting back on the sidelines. And on some level, some of this is out of the Fed's control. And on some level, it's good. But agree with Michael. I mean, we want this Fed to stay the course. And the thing is, for equities right now, we're not so sure. I think equities over the last 3 weeks, especially with the backup in yields, we're starting to wonder about that Fed put. And that's really what equities do still need to grapple with, because we want the Fed to stay the course. And equities still, I think the Fed's going to give in.
I'm not sure today, though, right?
They did like it. But this is the equities like the move in rates. So I'm not saying that the equities today doubted the Fed and actually or believe in the Fed to cut. Today was all about refunding because how much of the last 100 basis points was that announcement versus the last August refunding announcement? I mean, you can make an argument that a lot of this was all technical.
I agree. It was all about refunding. Do we want the Fed to keep course, stay course? They only control the front end anyway. What are they doing to the back end anyway?
Yeah, well, listen, I mean, the only way they're going to control the back end is by slowing growth. Right? Because the back end price is growth and inflation, to your point, Steve. But the way you control growth and inflation is by slowing.
If you agree
lending.
that this was supply, you have to agree that it was supply or demand issue, shocks to the economy, whether it was pandemic, whether it was printing, all the money that they printed. Monetary policy, fiscal policy are colliding.
Well, I mean, I don't think anybody can say right now that monetary policy is too tight. Right? We wouldn't have had 5% GDP if monetary policy was too tight. You wouldn't be printing, hundreds of thousands of jobs if monetary policy was too tight.